If you own physical silver, or if you have been following this market for years waiting for a major breakout, the events of the past few days deserve your attention. Something important may be changing beneath the surface of the silver market. This is not simply another discussion about whether silver might rise someday. What we are seeing today involves trade policy, industrial demand, physical supply, and global monetary trends all converging at the same time. The catalyst was unexpected. After months of negotiations, markets were increasingly confident that the United States and China were moving toward a new trade framework. Investors expected some level of compromise. Financial markets had largely priced in a gradual easing of tensions. Then everything changed. President Trump rejected the proposed agreement and sent negotiators back to the drawing board. Whether investors agree with that decision or not is beside the point. What matters is that markets suddenly had to reassess risk. When trade negotiations break down publicly, uncertainty spreads quickly. Commodity markets are often among the first to react. Gold immediately attracted safe haven demand. Silver moved higher as well, but its reaction was more restrained. At first glance, that might seem surprising. But silver occupies a unique position in the global economy. Unlike gold, which is primarily viewed as a monetary asset, silver serves two roles simultaneously. It is both a precious metal and a critical industrial material. Whenever uncertainty increases, investors know how to price gold. Silver is more complicated. The market must decide whether to focus on its monetary value or its industrial demand. Historically, this period of hesitation has often created opportunity. Gold tends to move first, silver often follows later. And when silver eventually catches up, the move can be dramatic. But the most important story may not be visible on a price chart. It may be unfolding inside the physical silver market itself. For months, signs of tightening supply have been appearing across the industry. Premiums on physical silver products have been rising. Dealer inventories have become less abundant. Delivery-ready inventories within major exchange systems have been trending lower. These developments suggest that the physical market may be stronger than the spot price alone implies. To understand why this matters, we need to look at how silver is priced. Most investors see the silver spot price quoted on financial websites every day. However, that price is heavily influenced by futures trading. The majority of futures contracts are never settled with physical metal. They are simply traded as financial instruments. Under normal circumstances, that system functions efficiently. But problems can emerge when physical demand begins to outpace available supply. If buyers increasingly want actual metal rather than paper exposure, pressure starts building beneath the surface. And that is exactly what many silver investors are watching today. At the same time, industrial demand remains remarkably strong. Silver has become one of the most strategically important metals in the modern economy. Solar energy is a major driver. Every solar panel requires silver because of its exceptional electrical conductivity. As countries continue expanding renewable energy infrastructure, silver consumption rises alongside it. Electric vehicles create additional demand. Silver is used in power management systems, charging infrastructure, and advanced electronics. The defense sector also consumes significant amounts of silver through radar systems, communications equipment, satellites, and precision technologies. Then there are the countless everyday applications that rarely make headlines. Consumer electronics, medical devices, telecommunications infrastructure, water purification systems, industrial automation. Silver touches nearly every corner of the modern economy. The challenge is that supply growth has not kept pace. Major silver-producing nations have not brought large volumes of new production online. Developing new mines requires enormous capital, extensive permitting, and years of construction. As a result, global silver production has remained relatively constrained while demand continues expanding. This creates a structural imbalance. Demand grows, supply struggles to keep up. Over time, that gap becomes increasingly difficult to ignore. Adding another layer to the story is the US dollar. Silver is priced globally in dollars. When the dollar weakens, silver becomes more affordable for international buyers. That often encourages additional demand from investors and industrial users outside the United States. Meanwhile, central banks around the world continue accumulating gold at historically elevated levels. Although most attention focuses on gold purchases, the broader message is important. Many countries are seeking greater diversification away from traditional reserve assets. In that environment, hard assets tend to attract growing interest. Silver benefits from many of the same forces supporting gold. But silver has one advantage gold does not. Silver is consumed, gold largely remains above ground. Silver is continually used in industrial processes and often becomes uneconomical to recover. That means available inventories can tighten over time even when production remains steady. There is also an important geopolitical dimension. The relationship between the United States and China remains one of the most influential economic relationships in the world. Any disruption affects supply chains, manufacturing decisions, investment flows, and commodity markets. China plays a central role in global silver refining and industrial consumption. If trade tensions intensify, businesses may seek to secure additional inventories as a precaution. Investors may do the same. That combination can create powerful demand from multiple directions simultaneously. The result is a market that becomes increasingly sensitive to supply constraints. Another metric attracting attention is the gold-to-silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, periods when the ratio becomes unusually elevated have often coincided with silver being undervalued relative to gold. Today, the ratio remains historically high. Gold has reached new record levels. Silver has advanced, but not nearly to the same extent. Some investors view this as evidence that silver has significant room to catch up if precious metals continue attracting capital. Of course, no investment thesis is without risk. Trade negotiations could improve. The Federal Reserve could maintain a stronger than expected monetary stance. Global economic growth could slow. Industrial demand could weaken. And silver has always been a volatile asset. Sharp price swings are part of its history. Anyone participating in this market should understand those risks. But despite the uncertainties, one fact remains clear. Silver today sits at the intersection of several powerful trends: growing industrial demand, constrained supply growth, physical market tightness, monetary uncertainty, geopolitical tension, and increasing interest in hard assets. None of these forces emerged overnight, they have been developing for years. The recent trade developments may simply have brought them into sharper focus. Whether silver moves next month or next year is impossible to know. Timing is always the hardest part, but the underlying conditions that have historically supported major silver bull markets appear to be strengthening rather than weakening. That is why, many experienced precious metals investors are paying close attention. Not because of headlines, not because of hype, but because the fundamentals beneath the surface continue pointing toward a market that may be tighter than most people realize.